Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. Today we want to continue with our series of advanced financial management, and as we had spoke last time in the previous video, we had completed the traditional theory of capital structure, and right now we are going to look at Modigliani and Miller, so that we see what they talked about in reference to capital structure. So we are looking at the Modigliani and Miller. The Modigliani and Miller. That is the M&M model. So we looked at the traditional approach, and we recognize the fact that the traditional approach allows us to borrow up to a certain point, which is the optimal point. It says that we borrow up to a certain point, and that certain point was actually the minimum point, so that we can be able, we reduce debt to a minimum point so that we can be able to reduce eventually the WACC, and once we reduce the WACC, then eventually it will be able to increase the cash flow that we are going to be receiving, because once we discount with a lower discount factor, which is our WACC or the cost of capital, it's going to give us a result that is a bit higher, and that will increase the value of the business. But now, when you look at Modigliani and Miller or M&M model, we want to look at how did these people react on the capital structure. Now, Modigliani and Miller, M&M says, for them they say, M&M says, they says that we borrow more, as like we borrow more. For them, their idea is just for us to borrow more and more. In other words, their argument is that they want companies to borrow more as they can, so that they can have a higher debt than equity. So the difference between these two modules is that the other traditional theory, it tells us that we should borrow up to a certain point, but this one, the M&M model tells us we borrow until we can see that we can't borrow anymore. We borrow more as we can. So the difference between these two capital structure is that the M&M tells us to borrow more, the other one tells us to borrow up to a certain point. In other words, this one is like they are telling us, because remember we said when we are computing the financial leverage, we said that the company is going to be highly geared if at all it has gone to 100%. So these guys, they are like telling us you borrow up to 99.9%. If they can give you money up to 99%, you borrow. Then you leave the other 0.1 to be equity. So this will be debt. So they want you to have 99.9% debt. Then the other 0. Of course, as I said, you can't have 100% debt, because we expect that by the time the owner starts up a business, maybe you have a land that you are going to maybe to use to construct whatever business you are going to be doing. So M&M tells us to borrow up to 99.9, meaning we borrow as much as we can. So what this model is talking about, for it did a lot of work on the effect of financial structure of a company on the cost of capital. For it, they did their analysis and they found that there is no such a relationship between you borrowing or between you having debt and equity in your capital structure on the cost of equity, on the cost of capital, or on the WACC that we are going to use. So M and M did not agree with the traditional theory view. So the traditional view, the traditionalists were saying you borrow up to a certain point, but these guys, they are saying borrow as more as you can as a business. So they argue that in a perfect, for them, they argue that in a perfect capital market without taxation, in a perfect market without taxation, of course, for them, they look at it in a sense that, because the other theory tells us that there is no taxation, there is no transaction costs. You see? But here they are telling you that if you are to have a perfect capital market without taxation and transaction costs, a firm, in other words, a firm's market value and the cost of capital will remain constant. That's the argument. That if you expect the capital markets to be perfect without anything to do with the taxation, without transaction costs, all those are kept constant, then a firm's market value can never be affected by the, in other words, the firm's market value and the cost of capital will never change. They will remain constant. In other words, the company's value cannot be affected by the cost of capital, whether it has gone up or it has gone down. So for them, they are saying that the company's market value and the cost of capital will remain invariant to the capital, to the changes in the capital structure, and also the value of the firm will not be affected. That's their argument. And M, for them, they produced a formula. They have a formula. They produced a formula expressing how the cost of the cost of equity, the WACC, and also the total market of the company are affected by the level of gearing. So they add their own formula. So for them, they are saying that has no problem, and they expressed that in a formula to see how the cost of capital, the cost of equity, and then the company's market value can be affected by the level of gearing. So this is the formula, M and M formula. Of course, we have KE. This M and M formula is actually going to help us to compute what we call WACC. So, but they gave it is in bits. So they have given us KE, of course, KEG, meaning equity and debt. There is some gearing, equal to KEU, KEG equals KEU plus, we open bracket, a bigger bracket, KEU minus KD, we close this bigger bracket, then we open another one, VD into 1 minus tax rate over VE. That is the formula they gave, where, of course, where KEG is equaling to the cost of equity of a geared company. In other words, we are looking at the cost of a geared company, cost of equity of a geared company. Then KEU is the cost of equity of ungeared company. Ungeared company. Then they are telling us that VD, of course, we know VE and VD. VE and VD, those are the market values of debt and equity. Debt and equity. Market value of debt and equity. Then the KD is what we call the pre-tax cost of debt. Then, of course, the last T, of course, our T, we know it is the tax rate. The tax rate or the rate of tax. So this is the formula for them. They are saying we can use to be able to determine the cost of capital, what we call the WACC. So they use what we call the cost of equity for a geared company. So cost of equity of a geared company is like, it's more of a company. They are trying to look at the cost of equity when that company has a debt in its capital structure. That is the meaning. Then this KEU is the cost of equity of an geared company. In other words, we are looking at the cost of equity for that company that is not having any debt in its capital structure. So that's the formula that they gave out. So if you try to look at this, for them, they are concluding that if you want to get your WACC, they also gave us WACC, the formula for computing WACC. They told us WACC will be equaling to the KEU into 1 minus, we open another bracket, this is VD, let me just call it VDT, small t, over VE plus VD. So that's the formula. So that's the formula you will see on, of course, if you check this formula will actually be, if this one and the other one will actually be on, this one we may not talk about it so much, but I'm just going to explain something small. So this one I'm not going to talk about it much because we already have a formula that we can use. But what I want to talk about more is the other first one that I gave. Now, of course, if you look at the question paper at the other side, they write it as, for them they use it as, I've just used the different letters, but for now, I just want to to illustrate how it is shown on the other exam past paper numbers in the other formula sheet. So for them, they write it a little bit differently, but it means the same thing. So for them, they are saying KE, which equals to KE, then they put an I here, plus 1 minus T, capital T, into KE I minus KD, then we close the, once you close the bracket, then they put VD. Of course, this one they use small d. VD and over VE. This formula and this one, they mean the same thing. It's only that this one has been arranged, because now if you know mathematics very well, you can actually take out all these issue here and you'll be able to come up to this formula here, because there is a t here. This is the small t. This t will come, remember this one is multiplying inside, so you take out when it comes inside the implication. Okay, let me just do it a little bit here just to illustrate. So you just have the KEU into, of course I'm going to multiply, this one will be 1, I multiply through, it is going to be, this is going to be V. I'm going to take out, let me take out this, I take out 1 minus t. When I take out 1 minus t and it becomes in the bracket, what has remained inside it will be, it is going to be actually VD over VE plus VD. But I need to remove, this is VD and this one is also VD. I can take out, I can decide to, of course, say, remember this one is in a bracket, or the other option would be you first get this one over 1. This is just making the other one the subject. You make this one, you take this one to be the whole, the one that is going to be the denominator. Then of course this one will come up here. This, if you do that, it will leave you, this item will actually be alone. If you cross multiply these ones, of course this one you divide by, it will remain with this will divide by this and it will go up. So you remove the V, the D. Of course this one will have the same as like the one here. It will be VE plus VD, like that, minus VDT over VE plus VD. So when I decide to take out, I chose to take out this T. Let me do it up down here. So when I try to take out 1 minus T, then what has remained there will be 1 minus VD over VE plus VD. That is the math that I've been talking about. This is a D. So by the time you roll around this very value will actually take you back to this. But what I want you to get is not how we derive at this, but just know that they are the same, because it is going to chop a little bit more time trying to. What I wanted to show you is that on the formula sheet it looks like this. And now, of course, this KE, for them the KE is the one that I'm calling KEG, this one. Then the KEI is the one that I call the KEU. They have just changed the letters, but they mean the same thing. So that's it. So if let's say we have a simulation, because someone is going to be wondering, how can I be able to do such a number? Now, when we are doing a simulation, we are going to make sure that we say that, of course, in the question they will bring issues. They can say the company that is ungeared, it means that that company is going to be using debt. sorry, it's not going to be using debt in its capital structure, but it's completely going to be using what we call equity in its capital structure. So the formula that we are seeing here, it helps us to compute the cost of equity. Remember, when you are getting the WACC, there is an adjustment for that KE, the cost of equity. So we are going to do a simple simulation to help ourselves understand this kind of how can I be able to of course go through this kind of analysis, and I be able to have, we are going to have a number. But before we do that, maybe let's first look at the weaknesses. What are the weaknesses of this model? Weaknesses of M&M theory, Modigliani and Miller theory. What are the weaknesses? So number one, the risks for the investor may differ. There is that kind of difference in risks, risk acceptance. You may find some of these people, they may not. You find those that are going to say that risks that are going to be in a geared company, and there are those, of course, the risks, the difference in the risk that I'm talking about, it is in the sense that the investors may differ between personal, they may have that kind of personal gearing and then corporational gearing. They may look at it as a little bit something that is different. So the risks for the investor may differ between personal gearing and then corporational gearing or corporate gearing. There is a difference between you, the person, obtaining the money, because you got maybe the money that you are going to invest in the business. Maybe you got it from loan, but there is when the company itself will actually pick the money from, because the loan that I have picked, me as the owner, is not going to be on the company, it's going to be on me. So it is going to create that kind of difference, that I may pick a personal, it could be a personal gearing where I picked money on my behalf. But there is when the corporation itself, the company, is the one picking the loan. So there is some kind of risk being differing from whether it is a personal gearing or it's a corporate gearing. So the other is the cost of borrowing. The cost of borrowing for an individual. The cost of borrowing for an individual is likely to be a little bit higher as compared to the cost of borrowing for a company. But when you look at M&M assumes that the cost is the same. In other words, the cost for personal borrowers and then the corporate borrowers, it assumes that it is the same, which is a weakness. Remember, whenever we are talking about the weaknesses, it's like we are talking about the limitations of the model. So these limitations, they are the ones that we are trying to criticize. We are criticizing the model's assumptions. So for them, they are saying that the cost of borrowing is more or less the same, whether you are going in for personal, which is totally different. When you go to these banks, if you are borrowing as a person, they charge you a completely different interest from what they are charging corporations, because you can't have the same assets, like the securities that you are going to put there for you to be able to access a relatively lower or cheaper source. Because when you're going in as a person, it is always risky for them to give you the money. There is a very big difference. Me to give you the risk between giving someone as in a person is higher than actually giving a corporation, because for the company even if the owner dies, it will remain there. But if I die with your money, it has also gone. So there is a risk, that there is that difference in the risk, and at the same time even the cost of borrowing will not be the same. The other, they are talking about the transaction costs. Transaction costs, of course, transaction cost will restrict the arbitrage process. Now, arbitrage process is like switching. You are trying to switch. That kind of switching involves buying and selling of the same securities in different markets until the market price is in equilibrium, such that the person who's actually doing that process can be able to take a riskless effort. Because since we are going to be buying, the other company is going to be buy and sell, you buy and they sell, but there is, if the market is not a little bit maybe fixed, if the market situation is up and down, you can't, it is going to disturb the process of actually buying and selling those shares. And that's how it is, because the price can't be in equilibrium. It can't be like it is constant, the market price for the shares. Of course, M&M also ignores taxation. It ignores taxation and even the tax implication. Of course, when you ignore tax, even its implication, you have ignored it. And this is a very serious problem, because one of the key advantages of debt is that tax relief on debt, like on interest payment. Once you pay tax, once you borrow money and you are paying interest, you'll have that tax saving for you, given the fact that you expense interest before you charge the tax. So all that implication, the model ignored it. Also, in practice, it may be a little bit impossible to identify firms with identical business risks and operating characteristics. It will be very hard. Even the companies that are within the same industry, they may differ. Maybe they may differ in terms of the capital. They may differ in terms of the number of customers they have. There's always that kind of difference. So it's not always the same as the model is trying to look at it. The other is the fact that some earnings may be retained, which is also against the model, because once you are going to be retaining the earnings you have made, all the profits that you have made, so the simplification assumption of paying out all the earnings as dividend won't apply for sure, because because for them they are assuming that all the money is going to be paid out in dividends. All the investors are expecting to receive dividends, but not necessarily that all the money that has been generated is going to be given out in dividends. Some money is going to be retained in the business. The other, they also trying to say that the investors are rational. So investors, the model tries to assume that the investors are going to be, they assume to act rationally, which may not be the case, of course, in practice. So the other thing is the fact that under the M&M model, risk is measured entirely by variability of cash flows, ignoring the possibility that cash flows may cease because of bankruptcy. Because once the company can't be able to pay, then that assumption is not going to be valid, especially when we have very higher levels of gearing. Then the other is the fact that the corporate borrowing doesn't expose the investors to personal liability. Remember, we have that limited liability, that you are going to be only limited to the amount of share capital that you have not yet paid. But once the company doesn't actually have the money to pay off its creditors, then you as the owner, you are not supposed to go beyond the share contribution that you are supposed to provide to the entity in case of any kind of bankruptcy or insolvency. So it's also going to be a little bit creating a variation, which is not the case with personal borrowing, because what personal borrowing does, you sell whatever you have to pay people's money. That's it. So that's basically what I wanted us to look at. So if you look at the implication of that, and also the implication, we looked at the implication of the other traditional theory, and we said that once the company has reached its optimal level, it should maintain that level of gearing. So if it has reached, let's say 50%, let's say if it is a country and it has reached maybe 50% of its GDP, and that is maybe the threshold according to IMF and World Bank, what they tell, then we shouldn't allow them to exceed that. So they should maintain that threshold. Even in borrowing, when you go to the bank, they actually tell you, they ask you to see how much you earn, so that they can see how much are you affordable, because the regulator, Bank of Uganda, says you shouldn't exceed 50% of someone who's net pay. But of course, for civil servants, of course, you know what happens. You can be having a loan in your mother bank, they have deducted maybe 50% of your net. And then you also go to a microfinance, because we have different tiers and they are all regulated differently. Commercial banks are going to be regulated by Bank of Uganda, but you can actually come to microfinance and they give you money. So for them, they will be like, no, for us, we shall just take 48% of your gross. Then after getting that figure, they will take off, of course, they will take off the statutory deductions, like the pay as you earn, that is the tax. Then also NSS if it is there, local service tax if it is there. Then what has been left, they will also chop that. But for them, they will use the other single code. That kind of, because there are two ways. You can deduct money directly, or it can be through standing orders, or it can be through coding, payroll system. So it has that kind of threshold. So that's basically what I wanted to talk about as far as Modigliani and Miller is concerned. We are now going to look at a simulation under Modigliani and Miller, so that we can be able to see how we can execute that formula that we saw. So let's meet in the next video as we are talking about a simulation. We see what to do.